Everybody. I'd like to kick off by extending a very warm welcome to all the business owners and entrepreneurs, and a very special welcome to our clients who have joined us this morning. And I believe that we have something like 175 people registered for this webinar around the country today. And I guess everybody is probably feeling the pinch in their pockets and trying to find out ways to save tax. My name is Monique Sharland, and I'm the founder and the CEO of the National Franchise Company Business Accounting Network, or better known as BAN. And I've been a professional accountant for almost 33 years, or some of 33 years, and that's probably giving my age away, and have specialized in micro, small, and medium business tax law for just as long. Which means that this webinar is going to focus on this sector of business and obviously not large corporates or public companies. I'm also a franchising expert, having founded BAN almost 20 years ago, and have grown it nationally to what it is today. And my background is, prior to establishing BAN, I was with one of the top 5 audit firms in South Africa. So before we begin, it's important to understand that the information in this webinar is for general purposes only and is not a substitute for professional advice. We take obviously no responsibility. BAN or BAN's independent franchises don't take any responsibility for any actions taken or not taken on the basis of the information in this webinar. And tax tip number 1, only obtain tax advice from a reputable and knowledgeable registered tax practitioner. Never listen to free advice, especially from unqualified friends and family like we often do around the bride. It's all hearsay. It can get you into trouble and also into some serious financial distress. So before we begin, I just would like to understand our audience today. So Shane, if you could please run the first of the 2 polls.
We have got, in the response to our first poll there, we've got the majority, 42%. So that's just over 4 out of every 10 attendees that have participated in this poll are accountants and bookkeepers. And I see that that was actually meant to have tax practitioners, and sorry, Monique, that has fallen off there. But anyway, and then the next favorite is 36% companies and close corporation business owners. 14% sole proprietors and partnership business owners, a very small smattering of the other 2 entities there. So I'm going to write the results of the second poll. The general size of our attendees' businesses, Monique, I can tell you that the majority, 39%, so that's just under 4 out of every 10 attendees are running that first category, 3 employees or less. That's the favorite. The next one is not applicable. We've got 28%. And then 17%, 50 employees or less, 14%, 4 to 10 employees. We've only got 1% more than 50 employees overall. So there we go. Back to you. Thanks, Monique.
Well, that's a very interesting result, and it obviously gives me some understanding of who our audience is today. So before we start, we notice that this webinar is called Tax Tips. We haven't called it specifically Income Tax Tips because there are various types of tax. We are taxed to death, as we say, in all sorts of various ways, and we will be covering various aspects of tax this morning. So just to give you some indication of some of the tax that we are subjected to, and this is not these aren't all types of taxes. I've only been able to fit these taxes on the screen. So there's income tax, there's corporate tax, pay as you earn, provisional tax, which is your Schedule 4, fringe benefits tax, which is your Schedule 7, capital gains tax, your Schedule 8. That's for the majority of the accountants and tax practitioners that are listening today. Then we have dividend withholding tax, donations tax, and even skills development levies and UIF is a form of tax. We have value-added tax, transfer duties, custom and excise duty, estate duty, securities transfer tax, ad valorem excise duties for certain industries, sugar tax, municipal rates are taxes too. And we haven't even stopped at the entire list. So I'm sure most of you are totally overwhelmed by actually how many hidden taxes you are paying every single day. So we'll just be covering certain aspects. We're going to be looking at corporate tax, When we look at corporate tax, that means companies and closed corporations. So when I mention a company throughout the webinar, it includes closed corporations. Also, when I mention shareholders, it includes members of closed corporations. The tax law does not differentiate between a company and a closed corporation. And we're going to be looking at some pay-as-you-earn, and that's for sole proprietors, mostly, or people in partnership, trading in partnership, and also, of course, employees. We're going to look at a little bit of fringe benefits tax and some capital gains tax, and we're going to touch on dividend withholding tax, and lastly, value-added tax. So we do have a lot to cover, and let's get going. Right, the things that we're going to discuss this morning, the first thing is common mistakes that us as accountants in BAN see small and medium businesses make, and how to avoid those mistakes. Ignorance of the law is obviously no excuse, so we're going to look at certain tax and VAT stuff that you as a business owner needs to watch out for. And we're going to also look at what SARS knows about you that you really do need to know. And we're going to end off on a much happier and a much lighter note, how to pay less tax made simple. Now, this is a seminar that I've done in the past, which is a 2.5-hour seminar. And I've had to cut it down considerably in order to get it to fit into 1 hour. So there's a lot more that I could be talking to you about with regards to tax, and I'm actually going to bring that up in our next webinar, which we're going to hold in November. So do make a note that in November, you will be invited, if you've joined this webinar, to some more tax tips. Right, let's start off with the first common mistake that a lot of business owners make and how to avoid them. And this refers to the Income Tax Act. Now, a lot of small business owners would like to deduct home office expenses because very often they work from home, or they might work from home and still have other premises that they go to, and they want to try and lower their tax as much as possible. Now, when you deduct home expenses, usually they would use a pro rata square meterage of the office space you use in your primary residence over the total square meterage of all the buildings on that primary residence, and use that as a ratio to deduct expenses like interest on bonds, rates and taxes, and so on. Now, you need to be very, very careful of doing that, because as soon as you start deducting home expenses in your business, you're changing the nature of your primary residence to that of a business residence, which means that when you sell your home one day, and it could be in 5 years' time, 10 years' time, 20 years' time, you are going to lose your primary residence exemption of $2 million on capital gains tax. Now, of course, you can pro rata the amount that you claim on home expenses every year, and your R2 million exemption will be reduced on a pro rata basis by the home office expenses that you claim. However, I would advise against doing that, simply because most people buy the residence and they stay in that residence for 5, 10, 15, 20 years. 20 years down the line, how are you going to prove to SARS what those home expenses were for the last 20 years so that they don't deduct more than the R2 million exemption? So my advice there would be, rather don't deduct home office expenses, because really the amount of tax that you're going to save on that is absolutely negligible compared to having 760,000 Rand capital gain added to your taxable income if you do claim those home office expenses. Right, another common mistake that we see businesses make, and again, we obviously need to see how we can avoid them. And this one is a little bit more complex, but we see it in small businesses all the time. And that is when we're looking at shareholders or directors' salaries. Obviously, it includes members. Directors and members are employees in terms of tax law. They are defined as an employee. So members, directors, you're regarded in the same light as your own employees, even though you may be the boss. So therefore, the monies that you draw from your company can be deemed to be a salary if the company does not owe you any monies on a loan account. In other words, you put money in as a director or shareholder or a member into your company, because if you didn't have money in your company, how would your customers be financed by the time they pay you? How do you buy new stock? How do you replenish that stock? So business owners would always need to have some equity in the business so that it can run the cash flows of that particular business. Now, what happens in small businesses is that a director sometimes does not have the monies owed to the director by the company on loan account. But then the director goes ahead and draws out more money from the company than his or her net salary amount. So how do you determine your net salary amount? It's determined by the amount of PAYE, pay as you earn tax, that you pay every single month. That would deem what your salary would in fact be. Now, when you start drawing out monies in excess of that salary amount, and the company doesn't owe you any monies, you have what we call a deemed dividend. And it's a contingent liability in the company, because effectively you are actually drawing out profits of the company, and there's a deemed distribution of those profits because you haven't paid PAYE on your salary. So to try and simplify this a little bit more, I'm going to give you an example of a balance sheet. And it's a very simple one, and I know most of you, of the accountants with us today, will obviously understand this, but some of the business owners, this might be a little, let me go through it with you. So we've got assets on the left-hand side, which is property, plant, and equipment, depending on what kind of business you're running. If you're running a manufacturing business, you might have some machinery in there. If you're running a service industry, you might have some computer equipment, furniture, fixtures, fittings, and so on. Now, in this company, right underneath there, you'll see a shareholder's loan account. It could even be a member's loan account. Remember, they are one and the same thing. This is an amount of 750,000 Rand that this shareholder actually owes their company because they have drawn out more money from the company than what is deemed to be their salary based on the PAYE that they pay every month. And then if you look at liabilities, there's a retained income amount of 940,000. That 940,000 is obviously accumulated profits that this company has made over the several years. Now, because that retained income exceeds 940,000, exceeds the shareholder's loan account of 750,000, we have a solvent company here, which is a good thing. If it had to be the other way around, we have an insolvency situation. But that's not the problem. The problem that we have here is now the shareholder, because they owe money to the company of 750,000 Rand, is going to be a deemed dividend, that's 750,000 Rand, out of the retained income of 940,000. So in other words, 750,000 Rand times 20% dividend withholding tax suddenly becomes due and payable to SARS, and that equates to 150,000 Rand. The only way to circumvent that deemed dividend is to charge interest on that shareholder's loan account. So if a shareholder had to go to the bank and borrow 750,000 Rand, the bank is going to charge interest. In this instance, the company is not the shareholder. There are two separate legal entities. The company needs to receive some interest from the shareholder on that loan account, which is taxable in the company at 28%. So immediately, the situation will generate interest income into the company at 28%, or if that interest is not charged, and it needs to be charged at the official interest rate, it cannot be charged less than that, which SARS publishes from time to time. Otherwise, there's a deemed dividend distribution. And all of a sudden, the company might land up with 150,000 Rand bill to pay on dividends tax. So to ensure the way around this, to solve this problem, that you draw out of your company a salary and you pay PAYE on as much as you need to draw out of the company to live and to meet your personal expenses. Right, very big area that we have with regards to small business owners on a section of the Tax Act, which is Schedule 7, and that is taxation on fringe benefits. Now, with taxation on fringe benefits, you've got to ask yourself, how many of you give gifts, for example, to your staff? Like, for instance, they've done well this month, and you give them, say, a 500 Rand Woolworths gift voucher. You deduct PAYE from that when you remunerate them at the end of the month. Some of you might think, okay, I'll give a restaurant meal reward. Here's a voucher for a nice top restaurant. Take your husband, take your wife. And that's really a thank you for a really good month. That meal voucher is subject to PAYE in the hands of that employee. Another one is, and this is where owners of businesses are the biggest culprits, the directors and the members, they take out their wife or their husband or their kids for a meal and they put it through their business as entertainment. Now, that is a fringe benefit in the hands of the member or the director, because the members and directors are regarded as employees. And those amounts should be added onto the remuneration and taxed. Another one is interest-free loans to employees. And if it exceeds, if a loan or accumulation of the loans to an individual or an employee exceeds 3,000 Rand, and you're not charging interest, the company's not charging interest on that loan account, or they are charging interest, but it's below the official interest rate, that becomes a fringe benefit tax. Now, the difference of the interest amount gets added onto the income of that individual and taxed. Also, the other thing we see quite often is maybe you've linked money to your staff, maybe 3,000, 4,000, 5,000, maybe they need to buy a fridge, their fridge is backed up, they don't have the money to do so, they come to you and they ask you for a 5,000 Rand loan to buy a fridge, and come the end of the year, you say to your staff member, look, I know you can't afford to pay back that loan, so I'll tell you what I'll do, I will scrap the loan in lieu of a bonus. So you don't need to pay that loan back anymore. That transaction is a fringe benefit to that employee of that 5,000 Rand and needs to be added onto their income and taxed. Another thing that we find quite often is, particularly in the retail industry and the manufacturing industries, is where the business owners give their staff what we call like stock vouchers. So come the end of the year, you've done well, tell you what, we make cosmetics, for example, you can take 5 or 6 different cosmetic packages instead of paying you a bonus. So they give them, the staff member, an actual stock amount instead of a monetary amount. The value of that is taxable as a fringe benefit in the hands of that particular employee. And if there is any employee debt that's owed to a company, we have also seen where company directors or members decide, okay, I tell you what, you owe 5,000 Rand to the company, so when I pay you next month, I'm going to take that 5,000 Rand off, but you're going to save some tax because I'm going to take it off your gross amount and then tax you on the net amount so you can pay less tax. Guys, again, that is a fringe benefit and it is fully taxable. Some of you might have holiday accommodation that's held in a company or trust. If you as a director or member or any of your staff go there on holidays, do you actually pay the company for that holiday? So there is even a fringe benefit, and this is only obviously applies when a company or trust actually owns a holiday accommodation. And if people are staying in that holiday accommodation and not paying for that accommodation, like the directors or members or some of their top employees or managers, that becomes a taxable benefit as well. So there is another one is long service awards. So very often we're not quite sure what those long service awards are and when does it become taxable as a fringe benefit and when it doesn't. So it's tax-free. A long service award is tax-free provided that the employee has had unbroken service for 15 years and the amount does not exceed 5,000 Rand. That has been in the Tax Act forever and a day. I mean, I've been in tax law for the last 33 years and I don't recall that ever changing. So it's probably about time that the Tax Act, in fact, actually looked at some of these amounts. So if you give your staff member a reward of 3,000 Rand and they've only been with you 10 years, or you give them a gold watch for 10 years, and that value of that gold watch becomes a fringe benefit, you're giving them an asset out of the company, it becomes a fringe benefit, the value of that watch, and it gets added to their remuneration, that amount, and taxed. Now, these are some of the things that I'm going through with the business owners, simply because this is the first thing that a SARS payroll audit will look at. They will look at your cash book, they would look at all the payments coming out of your cash book, and they want to know who those payments were for and what were they for. And it's very easy to pick up these fringe benefits. What I would like to suggest to all our business owners listening today, please make sure that you tell your payroll administrator each time that you are paying a fringe benefit to an employee. They need to add it onto the payroll, and it needs to be taxed accordingly. So if you're using an outsourced accountant to do your payroll, the responsibility is entirely on you as the employer, not your tax practitioner, to ensure that these fringe benefits are in fact included and that you are not running a massive contingent liability in your company, which unfortunately can end you up with a massive tax bill and even possibly, hopefully not, but possibly insolvency. Now that is income tax on fringe benefits. Now the next question is, sorry, I just want to, I think I've skipped the slide. Right, something to also understand with regards to criminal offences, with regards to taxpayers and personal liability. Now, this is a section in the Tax Administration Act, and it's very important for you as a business owner to know what these criminal offences are, and usually they will only come about if you are really a delinquent taxpayer. So the first one to know is that if you fail or you neglect to register for a SARS under a tax act, say for example, you're a one-man sole proprietor and now you decide you're going to take on a permanent labourer that's going to work with you permanently, you need to register as an employer. And you need to, if they're not even subject to PAYE, you at least need to pay over the UIF. Now, if you fail or neglect to register for pay as you earn as an employer, this can be a criminal offence. Also, if you fail or neglect to notify SARS of a change in registered particulars, so your registered particulars is the location of your business. So especially for instance, companies, you might be in location number 1 and then you decide to move to other premises, you need to notify SARS. It's a criminal offence if you don't. And it's not just your registered particulars and your local address, it's your email address, it's your contact telephone numbers and everything. If you fail or neglect to retain records as required by any tax law. Now the records is your accounting, your books of accounts. So if you neglect to retain those books, it also includes invoices, receipts, bank statements, etc., etc. If you neglect to do that, unfortunately, that is a criminal offence. Issues erroneous, incomplete, or false returns. Now, this is the scary one because you can make a mistake on a return. Erroneous means a mistake, which you are totally unaware of. And it's a very broad criminal offence because it says even if you make a mistake on a return, you can be prosecuted. If you refuse or neglect to reply to or answer any questions put by a SARS official, so if SARS says to you, okay, you submitted your VAT return, we now want a verification, please send X, Y, and Z tax invoices, and you decide you're going to ignore it because you don't know where the tax invoices are, that can be a criminal offence. If you fail or you neglect to disclose to SARS any material facts under any tax act, and if you fail or neglect to notify SARS of anything which is required to be notified to SARS under the Tax Act, which again is a very broad offence. Right, so what does SARS know about your business that you need to know? So if you're a company and you submit your IT14 annual tax return every year, which you should do, what will come back to you within a couple of minutes or even a day or two is what they call an IT14 SD, a supplementary disclosure to that company tax return. Now, what that supplementary disclosure asks you to do is the first thing is to look at your turnover per what you have submitted on your VAT returns and compare that to your turnover that you've submitted on your IT14 tax return. Now, when we talk about the IT14 tax return, we must bear in mind that those figures that are on that tax return are your financial statement figures. So your financial statements will have turnover or sales of X. You've already told SARS during the course of the year what your sales are. If your sales are a lot more than what you've said on your VAT 201, then you have a problem. That's a red flag for a SARS audit. So the question is, does your bookkeeper or does your accountant regularly reconcile your IT14 tax, your IT14, or not your IT14, but your books of accounts turnover to your VAT 201s? Right, the next one on the IT14 supplementary disclosure is VAT input claims for the VAT 201 returns and the IT14. So you've already told SARS during the course of the year, this is the capital acquisitions. I've bought a new computer, I've claimed VAT on that. So you put that on your VAT 201 as capital input VAT. Then you have got certain expenses that you've claimed VAT on, and you put that on your VAT 201 return. Now, SARS gets your annual financial statements, which is also reflected on your IT14, and they do a quick reconciliation and say, wow, you know what? It looks like you have claimed more VAT input than what you're entitled to, and that's going to be an absolute red flag. So you've got to ask yourself the question, does the person doing your VAT reconcile every second month the turnover to the books of account, number one, and number two, the expenses and the capital acquisitions to the books of account? They need to do that every second month, because if you're going to only do that once a year, it's too late and you can't rectify any mistakes. The third thing on an IT14 SD is they would look at the salaries and wages that you claim on your IT14 or obviously in your financial statements, because your IT14 relates to your financial statements. And that obviously includes directors and members' emoluments. And they compare that to the IRP5 and the IT3A certificates that you submit. So if that does not gel and that doesn't compare, you have also raised a red flag, and it'll be a payroll audit. So a lot of small business owners make the mistake that they go and put through wives' salaries and casual labor, etc., and those individuals are not even on their payroll. And so they don't issue an IT3A certificate, which means that their salary and wages expenses way exceed the certificates that the issue. That is a red flag. So make sure, even if it's a casual person, and I know some of you know, in industry, you might pick up one guy for one day, and the next day he doesn't pitch, and the next day you've got to find another guy. Believe it or not, all these people need to get onto your payroll so that you can issue these IT3A certificates, especially in industries like, for instance, the construction industry with a large labor force, or carpet cleaning industries with a labor force. It's very important that that gets done. If it doesn't get done, then SARS can also disallow that as a tax deduction, the amounts of salaries and wages that you've not included in your payroll system. Right, and lastly, the IT40 ST will reconcile income tax as the liability or asset that you reflect in your IT14, and they will reconcile it to what SARS's records are. So you need to do this on the IT14 ST. Now, if you've got a good accountant, I know with BAN, we all make sure every second month that these reconciliations, 1, 2, and 3, 1, 2 is done bi-monthly whenever our clients submit VAT returns. Number 3 gets done biannually when we submit IRP5 certificates, and of course the income tax would only be reconciled once a year. And of course, SARS also knows about your registrable assets, motor vehicles that you buy, caravans, motorbikes, properties. So they literally sit with all that information at their computers. The deeds office, they can just access that immediately. So it's important that you disclose everything correctly, because they can easily pick up what you might not be disclosing. So just to give you an example of one of our clients out of many, where there was a SARS red flag and they did a full-blown audit, and it was a chain of pharmacies, and this industry receives relatively large kickbacks, say, for discounts from pharmaceutical companies when certain purchases of certain stock is achieved. Now, the bookkeeper in this pharmacy, in her wisdom, posted these discounts that they received against stock purchases, effectively reducing the cost of sales. So SARS did a VAT input recon, and they queried why the VAT inputs were so high in cost of sales in comparison to the expense. And on investigation, these discounts were discovered sitting in the cost of sales, and no VAT output had been paid on them because they should have had VAT output paid on them. And of course, there was a huge assessment and penalties that were raised as a result of it. So IT14 ST SARS can pick up much, and it's important to make sure that your accountant is actually doing these recons regularly. Okay, something that we've come across in the last couple of years, and that is that SARS can raise an assessment on an estimate, okay, telling you you've got to pay tax on their own estimate based on information that SARS has, if you as the taxpayer fails to submit a return as required. Now, this refers to Section 95(1) and 95(2) of the Tax Administration Act. Now, what is so important here, of course, is to keep your records up to date and keep your returns up to date. Because if you don't, there is quite a significant consequence, which I'll show you on the next slide. SARS can actually dip into your bank account and help themselves to that outstanding tax debt that they have estimated. So we've had a situation about 2 years ago. We had a client, he had 398,000 Rand, in fact, cleared out his bank account, his ABSA bank account, and his call accounts. We got a phone call from the ABSA bank manager and said, look, they've got a legitimate SARS instruction that the bank has to pay the monies over to SARS. They wiped out his call account, everything, and they placed this national food restaurant franchise in jeopardy. So please, you need to be aware that SARS are now withdrawing funds out of a company's bank account without you as the taxpayer actually receiving any official notification. And this has happened a couple of times for some of our clients where SARS has cleaned out their bank account for taxes owing based on the fact that they have not been submitting their returns. And this could result, obviously, in taxpayers being prejudiced. For example, SARS helps itself to your entire salary and you can't meet your financial obligations. What should happen, SARS should communicate with taxpayers before they take any debt recovery steps. So if this is not followed, obviously you as a taxpayer have a right to complain. But the problem here is, and it's important for taxpayers to update their registered details with SARS. Each time they, for example, change their contact numbers or your address or your work details, because in most of these circumstances that we have found, these taxpayers have not updated their details with SARS. So SARS has in fact communicated with them, but because they haven't updated their details, they are unaware of those communications, and all of a sudden they dip straight into the bank account and take those taxes due. Right, let's look at some tips. Very importantly, the first one is to apply for a tax clearance certificate every year. I believe it's not an actual certificate anymore. I think it's an electronic certificate. Be that as it may, it's important that you apply for this tax clearance certificate every year, which will look at your employee's tax up to date, your VAT up to date, your income tax up to date. Because if you don't see what your tax situation is on a yearly basis, did you know that without a tax clearance certificate, you cannot sell your property if you've got property to sell? You cannot purchase property if you don't have a tax clearance certificate. You can't submit tenders. And they're now even looking at having a requisition that you need a tax clearance certificate for obtaining loans from banks. They have not yet done that, but they are looking at doing that as well. So tax clearance certificates are important that you do get every year. And just some other tips, good financial management for small business owners. Guys, you know every single month what your VAT output is going to be because you know what your turnover is, you know what your VAT output is going to be that you're going to owe SARS. Remember, you're collecting that VAT on behalf of a third party. It's not your money. So my suggestion is take that money out of your operating bank account so you don't see it there and you don't think, oh, maybe I can pay myself a bonus this month because there's a lot of money sitting in my bank account. Take it, it's not your money, take it out of your operating account, open up a money market call account and put the money there. And do that every month. Obviously reduce that amount, that output VAT by some of the average sort of input VAT that you would normally claim in your business. and keep it on the call account. So in 2 months' time, when you've got your VAT bill, you've got the money to pay for it. Now, likewise, I would suggest that you do the same with tax. Now, when we ask most small business owners, do you know how much provisional tax you need to pay come August or February? And the answer is always, no, I'm going to wait for my accountant to tell me, which usually happens a week before payment is due, and they don't have the cash to pay it anyway. Now, guys, a good accountant, and I can tell you now, all brand franchisees, when they prepare management accounts, which is an absolute critical thing that all businesses should have, we calculate how much tax is owing every single month in those management accounts. So you, as the taxpayer, know what one of your biggest creditors are. So if you ask a small business owner, do you know how much you've got to pay your creditors, for instance, your rent, your stationery, your telephone, some of your suppliers, they will know exactly how much they've got to pay those suppliers. But when you ask them how much tax, which is also creditor, SARS is a major creditor, they don't know. So guys, this is why it is so imperative to have management accounts from a good accountant where they are absolutely accurate so that they can give an accurate taxable income and they can actually calculate tax so that you know every single month what you need to put aside, and then open up a money market account and put that money away monthly. So when provisional tax time comes, you've already got the funds available. You might say, oh, but if I do that, I'm not going to have any money left in my operating account. So I never have money there, so that's going to be a problem. Well, then there's a problem with your business. And that's when you need to call your accountant to try and resolve or fix it. Just as much as if you've got a pain in your tummy, you're going to go to a medical doctor to try and get some relief for that pain. You need to try and obviously consult with your accountant to try and see what the problem is in your business. Okay, so we're going to do some good news amongst all this gloom. And I'm going to start off with some tax saving tips, and I'm going to share some more with you in November. So the first one I'd like to share with you today is to get your business structure right. Now, getting your business structure right, the way a company or closed corporation is set up has significant implications for the amount of tax that is paid. Now, I don't advocate a company structure for many micro and small businesses. And I would always say, before you ever form a company, guys, please get professional advice before you do. It does not mean to say because a small business company structure is the right entity for you, because once you go into a company, you need to weigh up the cost of compliance to the Companies Act, which is very costly, to the actual tax savings in getting your structure right. So if your business does qualify as a small business corporation and you've got professional advice and it's the best vehicle to trade in, the other best vehicle, of course, is a sole proprietor, but we can talk about that at another stage. Your business can save up to 95,070 Rand in tax per annum. So whilst the key is to structure the company or the closed corporation, so this only applies to companies and closed corporations, to the full advantage. However, we must also remember and bear in mind that as directors and members, even if you're in a small business corporation, you need to draw a salary every month. So you're going to pay tax on your individual tax rate, and more often than not, you're going to try and take your profits out by way of that remuneration, which means that your companies are going to pay tax anyway, which means that you're in exactly the same position as a sole proprietor who also pays individual tax on their profits. So it's very important that you do, in fact, get professional advice before deciding to open up a company and think that you can save 95,070 Rand in tax, when in fact your compliance with the Companies Act also gives you, heightens your costs. Okay, so how do you qualify for a small business corporation for tax purposes? Your gross turnover, first of all, can't exceed 20 million per annum, so it's really for small business. Applies only to companies and closed corporations. Unfortunately, it excludes sole proprietors. All shareholders must be natural persons and living, breathing person. They cannot be a company. Shareholder can't be a trust. The shareholders or members may not hold shares or members' interest in any private or unlisted companies, apart from certain exceptions. And for those exceptions, I would ask you to please ask your accountant to see whether you would qualify. Likewise, not more than 20% of the revenue of that company may consist collectively of investment income. Now, investment income is things like rental, interest received, dividends, or royalties, and the income from rendering of personal services. So in other words, the company cannot be what they call a personal service company. Now, that is another aspect completely. I'm not going to discuss it now because we don't have the time to discuss what a personal service company is. However, do ask your accountant to give you advice on that. And the small business corporation may not be a personal service provider. Now, that's a very, very important aspect of whether you qualify for small business corporation tax or not. So a personal service provider would be if you have less than 3 employees for the entire year and you provide accounting or bookkeeping services in a company, or you provide education services, or you're an architect or a draftsperson, or you're a lawyer and you're working with yourself and maybe 1 or 2 other people, or if you're in IT and you've got 1 or 2 people, or you work for yourself in a company, any kind of consulting work will not make you eligible. If that's the revenue, it won't make you eligible for small business corp tax, of course, unless you have more than 3 employees, and those employees must be employed for the entire year, and they cannot be your mother, your father, your sister, or your brother, or domestic. It needs to be a bona fide employee. Right, another tax saving tip: have your business pay interest on your credit loan account. So this is a small little tax savings. There's nothing major. But if your company does not qualify as a small business corporation, it has to pay the 28% tax. Then what you can do is that if you've got a credit loan account, in other words, your company owes you money, which is what it should always do, you can charge your company interest on your loan account, just as much as if you had that money in the bank instead of your company, the bank would pay you interest. Now, when the company pays you interest, it will be a tax deduction in the company. So you'll save 28% if you are not a small business corporation on that interest paid in the company. But of course, it's going to be income in your hands, that interest. And if you're not receiving interest from any other sources, as you know, the first 23,800 Rand is an interest exemption if you're under 65 in your personal hands. Now, that's tax-free. So you get a tax deduction in the company, plus you get the 23,800 Rand tax-free on that interest. Right, the next one we're looking at is VAT. And what a lot of business owners don't know is that you can claim what they call notional input VAT on a change in use of assets or on the purchase of second-hand goods. So what does that mean? That means as a company registered for VAT, you go or sole proprietor registered for VAT, you decide you're going to buy second-hand goods from a non-vendor, from somebody that won't charge you VAT because they're not VAT registered. Let's say it's an office desk and it's tables and chairs and whatever it might be, a computer, which I doubt you'll buy secondhand, anything that you're going to use in your business entirely. Because you haven't got a tax invoice from that particular supplier that you purchased those secondhand goods from, and because you're going to be using it in the furtherance of your enterprise, that amount that you pay for those goods is deemed to be inclusive of VAT. So you can take 15 over 115, which is your VAT rate now, on that amount that you paid, be it 10,000 Rand or whatever, and you can deduct that as an input VAT. Now, guys, that is money that SARS is giving you for absolutely nothing. And when you do purchase things for secondhand, the major thing that you need to know that's going to qualify you for that notional input VAT is if you complete a VAT 264 form. Without a VAT 264 form, they will disallow that notional input VAT. So just a quick story. I remember having a client some years ago in the publishing industry, and they were very much into nature and all those kind of things in this magazine that they published, and they would always sort of charter helicopters and so on to take aerial photographs, and they decided that costs too much, let's buy our own helicopter, which they did. and it was a second-hand helicopter. So this was for aerial photography for the magazine's features. They paid about 3 million for the second-hand helicopter, and I went along about a couple of months later because there was another problem with that, and I was asked to try and investigate and see what the issues were. And while I was analyzing what the issues were, I stumbled across this payment of 3 million. And I asked the bookkeeper, well, did you claim notional input VAT, and did you get a VAT 264 form completed? She says, no, you can't do that because the person was not registered for VAT, so she didn't claim the VAT. Now, that was 368,000 Rand that she did not claim for this company, which is a massive amount, as you can imagine. So it was within the 5-year period, obviously, that they bought this helicopter, and I did the necessary. I got hold of the seller of this helicopter, got them to complete some portion of the VAT 264 form, and we then eventually got this money back, or this notional input VAT, paid into the bank account of the client. So guys, you must make sure that whoever's doing your VAT returns does in fact know the VAT law, and they're not losing money for you. Right, next one is turnover tax, and whether you can actually really save on turnover tax. Now, we get this question quite often. Can you really save? And one has to do a calculation to see, and there's no straight answer to this question. I'm going to show you why. So let's take a situation where we've got, first of all, on turnover tax, who qualifies. So first of all, this includes sole proprietors as well as companies. So that's a good thing, unlike small business corporation tax. All natural persons must own the business. If it's a company, so no trusts or other companies as shareholders. Gross income under 1 million. Providers of professional services and personal service companies cannot elect to register. So again, your accountant, working from home, your lawyer, consultant, IT guy. Apply for registration prior to beginning of financial year. So in other words, if you want to register for turnover tax, you need to do it now for the 2021 tax year, because we are already in the 2020 tax year. You can't have less than 10% of total receipts. You must have less than 10%, sorry, of total receipts that consist of investment income like rental, interest, and so on. And you're disqualified if shares or interest held in the entity of other private companies or closed corporations. So if your business, you want to apply for turnover tax, but you are also a member of another closed corporation, or you have shares in another company, you will disqualify. So let's have a look at the actual calculation to see whether you can in fact save or not. And as I said, there's no fast and hard result to this. So here we have a micro entity under 1 million, and we're going to compare turnover tax to a company. Now, companies can either pay 28% or small business corporation tax, that's company tax, or if you're a sole trader, you're going to be paying tax at the rate of the tax tables as an individual. So let's have a look. Let's take an example. We've got tax based on a micro entity on turnover. But of course, when we calculate tax in a company, it's on profit. Small business corporation, the tax is based on profit, not turnover. And for a sole proprietor, the tax is based on profit, not on turnover. So it becomes a little bit more complex to try and compare. So let's take an example of an entity, a micro entity whose income is just under the million rand mark, 900,000. The tax on that is 11,150 Rand. So we can't do exactly the same with profit. So what we're going to do is we're going to compare the actual tax payable and see what the profit would need to be to pay the same tax on turnover. So a company paying 28% tax, they would need to make a profit of 39,821 in order to pay the same amount of tax on the turnover basis. For a small business corporation, you'll see that the profit jumps up to 238,350 Rand, whereas on sole props, the profit would be 140,944 Rand. Now, from these figures, I'm sure it's making it quite clear, is it better to register for turnover tax, yes or no? And we can't answer that question because we don't know what the profit is on the turnover tax. So the conclusion here is to analyze whether, based on number one, entirely dependent on the consistent annual profit of the entity. So every year they need to make a sort of tax would be more viable than paying tax on profit. The other thing with micro entities paying that's registered for turnover tax, the beauty of it is that they don't have to keep the accounting records, the owner's accounting records that a company or sole prop has to. All they really need to keep is the invoices that they invoice their customer, which makes it from a record keeping point of view much, much greater. However, for turnover tax, you can also register for VAT as a voluntary VAT registration. In that case, unfortunately, you are going to need to keep all the necessary accounting records. And then on the nature of the turnover, if the entity is a company, is your consulting business, which can't register for turnover tax, then you've got to, if it's a retail outlet, then obviously they can register. And one's got to see whether they qualify for small business corporation tax if it's a company. So one's got to look at a couple of factors. So there is no hard and fast rule. Right, another question that we get asked quite often is, what is better? Having a company car and paying fringe benefits on the use of a company car, or paying yourself a travel allowance? Now, this is quite a complex question because there's a lot of complex calculations that go behind the scenes. And you, first of all, need to know what information your accountant needs in order to calculate this. And hopefully by the end of these slides, you can see quite how complex it actually is to get to the answer. Now, there is actually one answer to this whole question, but it's important for you to understand how to get to that answer. So the first thing is we need to get the facts. Your accountant needs facts. Now, we need to know how much the vehicle is. And there's a determined value of that vehicle in terms of tax law. And for income tax purposes, that determined value means the cash price that you paid for the vehicle, including VAT and excluding finance charges. So let's say the vehicle is 200,000 Rand, including VAT, excluding finance charges. Now, the next question is, what is that individual's taxable remuneration per year? Because obviously we need to know what tax bracket they fall under in order to calculate what is going to be better. So value of fringe benefit and the travel allowance on the determined value. So what we're going to do is we're going to say we're going to use a fringe benefit value of 3.5% on the 200,000, and we are going to give the exact same value to a travel allowance so that we are comparing apples with apples, and that would be 84,000. But the next question your accountant's going to needs to know is how much from your logbook that you have to keep for the year is your business kilometers, how much is your private and personal kilometers, and how much is the total kilometers. From that information, we can start doing some calculations. But before we do the calculations, there's two ways of deducting travel allowances. One is on your actual expenditure incurred, and the second one is using the tables, SARS tables. Now, because I cannot compare the actual expenditure because I wouldn't know what that is, I'm going to compare a fringe benefit allowance to the actual travel allowance tables. So on a monthly basis, there is going to be additional tax that is going to be deducted from your salary for the fringe benefit and for the travel allowance. And usually you would deduct 80% of that travel allowance, sorry, 20% of the travel allowance, and 80% is subject to tax. Now, clearly from these business kilometers, they exceed the private and personal kilometers. Then you would use 20% not being taxed. So if it is 80% that is being taxed, you would be subject to 25,749 Rand tax per annum, or 6,078 Rand. That will come off your salary every single month if you equate that to every single month. And now you're going to submit your tax return. And in your tax return, your accountant's going to calculate how much out of that tax that you've already paid, how much are you actually entitled to for business travel. Right, so we're going to compare the fringe benefit with the allowance, and this is working on a 200,000 Rand vehicle. The actual tax for personal use is for a fringe benefit, 5,057 Rand. So we've been able to reduce the personal expenditure by that amount. And the allowance is 5816. Now, in this case, you are paying a little bit more tax. It's very marginal on an allowance than a fringe benefit. But that does not answer your question. It does not answer the question, what is better, a company car versus the travel allowance? So I'm going to look at another scenario where the fringe benefits actually becomes more than the allowance, the higher the value of the car. So now we're going to look at a vehicle of 500,000 Rand, including VAT. And the value of the fringe benefit then becomes 210,000 as opposed to the 84,000 that we worked on. We're using exactly the same amount of kilometers that we used in the previous example. So the additional tax that's going to come off your salary for the year, if 80% is subject to tax, is 65,000 in tax, and 15,000 if only 20% is subject to tax. So now let's have a look in this situation, the actual tax, once you've submitted a return based on those kilometers, 13,000 for the fringe benefit amount is payable, and the allowance is less, the tax on there is 10,000. So the higher the cost of the vehicle, the higher the tax on the fringe benefit compared to a travel allowance. And the lower the cost of the vehicle, the lower the tax on the fringe benefit. But the higher the tax, only marginally on the travel allowance. But that is not where you stop. When you compare these two, it's not about how much tax or how tax efficient the one is over the other. What you really got to look at is cash outflow. How much are you actually spending out of your pocket? So let's take the 200,000 Rand vehicle as an example. You had 84,000 Rand as your allowance. It's been reduced by the tax, giving you only 78,184 Rand cash in your pocket. Now let's have a look at the difference between fringe benefit and allowance from a cash outflow. In other words, how much money you're paying out of your pocket. So tax on the personal kilometers, fringe benefit, out of your pocket, you're going to pay 5037 and the allowance 5816. Now, under fringe benefit, that company vehicle is owned by the company. So the motor vehicle payments, if you are an employee and not a director, so you're not going to, in other words, be affected by how much profit you have in the company at the end of the day. If you're just a general employee, you are not going to pay motor vehicle repayments. The company is. But if you receive an allowance, you're going to have a cash outflow of your company, your motor vehicle repayments. Likewise with fuel, your company is going to pay your fuel. But you are under a fringe benefit. But if you receive a travel allowance, you're going to pay the fuel. That's if that's the agreement, by the way. Insurance as well. So if you're an employee, literally the only thing you're going to pay on that fringe benefit is 5037. However, if you receive a travel allowance, you are paying these other expenses as well, which means that the total of the expenses from an allowance, you're going to pay 94,300 Rand, which is all of this added up together, and you've only received an after-tax amount of 78,184. So in other words, your allowance is less than what your actual expenditure is. So you've got to see it from an employee that's not a director or somebody that does not have any interest in the shares or the profits of the company. You've got to compare that individual to somebody that is a director or a shareholder or a member that does have shares. So these are two very different ways of looking at how a travel allowance versus a company car can benefit an individual. So let's say you are a company shareholder or member. If you own a managed company, so you don't have any other partners, say for instance, and let's say that that company does not qualify for small business corporation tax, it's at 28%. Effectively, your expenditure as a company is only 63,708 Rand, as opposed to a travel allowance, a cash outflow of 94,300. That is because the company can claim all these expenses as a tax deduction on 28%, and they're reducing their expenditure by 28%. So the question now is, what actually wins at the end of the day? Travel allowance or a company car? And without a doubt, tax-free, okay, sorry, there's one more equation to this, and that is tax-free travel reimbursements. You can claim R3.61 per kilometer, unlimited kilometers, tax-free. So it's a reimbursive travel. It's not a travel allowance provided that you're only repaying at 3.3 Rand 61, and that's 2020's amount. And you need to compare that travel allowance that you receive, the tax-free portion, to the maximum tax-free travel reimbursement. So we're going to do that. So if we did the same amount of business kilometers as the travel allowance, 12,000 kilometers, at 3 Rand 61 will give us a tax-free cash in our pocket, 43,320 Rand annually. But now let's compare. The value of the travel allowance and the fringe benefit was 84,000 on a 200,000 Rand vehicle. Cash value of the travel allowance after tax before expenses was 78,184 Rand, if you recall from the 2 slides previously. But now if you look at a tax-free reimbursement as opposed to an allowance, you're only getting 43,320 Rand on the reimbursement. So here, obviously the travel allowance is better than a travel reimbursement. However, overall, buying a vehicle in the company wins all round, from a cash outflow out of your pocket point of view, and usually from a tax point of view. So I think we are running out of time, and I think what we're going to do is we're going to need to carry forward some of these other slides that I have on tax saving tips. I'm not sure if, I think Shane, could we look at another tax tip? Sorry. Right, next question that we also get asked quite often, is it more tax beneficial to pay a dividend or to pay a bonus to a director or a member? Now this obviously is a question relating to companies and closed corporations only and not to sole proprietors. So the question now, of course, is let's do a calculation to get to that answer, and it's important for business owners to understand how we actually calculate this. So we first got to establish what is the shareholders' normal remuneration. In other words, what do they get paid as a salary every month, and then you annualize it, and that, let's say in this example, the annualized salary is 720,000. Let's say the company makes a profit, a taxable profit of 300,000. The question is, let's say we want to distribute that profit of 300,000 with the knowledge that there is still retained income and equity in the company, so we're not going to distribute profits and get make the company insolvent or negative liquidity, so we would have tested that. So a company makes a taxable profit and we want to distribute that profit. Do we do it by way of dividend, or do we do it by way of adding it to the remuneration or to your remuneration? Right, so let's have a look and see the comparison between a dividend and a bonus. So if we're going to distribute a dividend, let's look at all the taxes that the company needs to pay first, and then we're going to compare those taxes to the taxes that the company that's going to be paid by the company on a bonus. So the tax on 720,000 for the year is 198,000, and the tax, let's say it's a 28% company, the tax on that profit of 300,000 will be 84,000. And then we're going to distribute that dividend of 300,000, so we got a dividend holding tax of 20% of 60,000. So if we want to distribute a dividend, it's going to cost us 342,021. Now this is, say, an owner-managed company. An owner-managed company is where you're the shareholder and the director. So total taxes would be 342,000. Let's compare that to a bonus. So let's say we had the 720,000 and we give you a bonus of 300,000, making your taxable income 1,020,000. Your tax then will be 321,000 on 1,020,000. Now you've distributed all the taxable profits, so there is no company tax. You're not going to declare dividend because there is no dividend to declare. So your total tax there on a bonus is 321,000 as opposed to 342,000. This is for companies and CCs that are subject to 28%. So guys, no matter when you do this calculation, it will always be better to pay a bonus than a dividend. And the reason for that is that the dividend withholding taxes effective tax rate is 42.4%. Now, to reach 42.4%, you need to earn an annual salary of 6,105,000. And when you go over the 6,105,000 salary per year, it will be better than to pay a dividend. Now, I'm sure most of you in small business are not going to earn that kind of money. So effectively, at all times, it's better to pay a bonus. However, that is not the case with a small business corporation. So if we look at a small business corporation, their tax on their profit is only 15,470 Rand as opposed to 84,000, which means that their total tax that they're going to pay on a dividend distribution is 273,000 as opposed to a bonus of 321,000. So for small business corporations, it's always better to declare a dividend than pay a bonus, as I said, unless the salary of that person exceeds 6.1 million. And then a bonus saving tip, you can save anything up to 143,500 Rand tax per year just by investing 27.5% of your taxable income, limited up to a maximum of 350,000 Rand. That means that up to a salary income, taxable salary income of 1.2 million, if you're putting away 27.5%, you can save 143,500 Rand in tax. And when you get to a situation where you become quite profitable, and I know most businesses are struggling at this time, there's very few that probably get to this situation. Really, guys, instead of paying yourself a higher salary or a bonus or a dividend and paying tax on that, all you're doing is you're just paying tax to SARS. Rather, pay yourself the bonus and then put that money away into a retirement annuity fund. And one last important thing, don't use tax practitioners who break the law. So I'm not sure if many of you know this, but it's a criminal offense in terms of the Tax Administration Act for any tax practitioner who neglects or fails to register as a tax practitioner with a controlling body and with SARS. And it can be subject to up to 2 years imprisonment or a fine. And just as you would only want to use a medical doctor or a qualified medical doctor for any aches and pains and accidents you might have, or a lawyer, a really good lawyer, they need to be qualified. So would your tax practitioner need to be qualified and registered. Right, our next webinar is going to be held on the 31st of October. So do make a note of it. Also starting at 9 o'clock. And it's going to be on Labour Relations 101, Getting Labour Relations Right. And our presenter of that webinar is Justine Del Monte, who is one of Business Accounting Network's Alliance partners. So do make a note of that. And then I'm open for questions. Shane? The question is from Evelyn, and she asks, what about paying life insurance premiums of directors? Is it a fringe benefit? Evelyn, yes, it is if you are expensing it in the company and the company is paying for it. So it is most certainly subject to fringe benefit tax because they are getting a benefit which is pretty much like remuneration. The other way of dealing with it is to take it to a loan account of the directors and not expense it in the company. That means that the directors would need to repay those insurance premiums at some stage back to the company. So yes, it is subject to, it is a fringe benefit. And the second question is from Jolene. Hi, Monique. SARS will not issue tax clearance certificates after October, only the PIN. Yes, I am aware. Thank you very much, Jolene. That is true. I am aware that SARS has changed its ways of issuing so-called tax clearance certificates. You're not going to get a paper certificate anymore. And I think that PIN is where you're going to log in and actually, and I'm not quite sure exactly how it works, but I would suggest that anybody requiring tax clearance certificates, and I'll still refer to them as that, need to speak to the accountant on how to access that. And then the third question from Jane, what interest rate do we apply on the company loan? That's a good question, Jane. And, you know, there is no set rule on what interest rate you can apply. So one thing I would suggest is that the interest rate tries to remain as consistent year after year, obviously taking into account inflation and the CPI index. So one thing I would suggest is that that interest that is paid on the company loan is not less than the official interest rate. And that official interest rate changes as well. And you can get an official interest rate update on the SARS website. Okay, I see there's another question coming in from Henrietta. If you bought new furniture from an exempt individual, can you also claim input VAT on it? So I'm presuming, Henrietta, when you say exempt individual, I am assuming that that individual is not a VAT vendor and not registered. If that furniture is new, it's not secondhand. So therefore, the answer to that question is no. It's only on second-hand goods that you can claim a notional input VAT. I hope that answers your question. I'm not sure if there's any more questions. Shane, over to you. Copies of the slides, simply because on, I think, our second slide, we refer to the fact that we would not like anybody to, the information that we're providing in this webinar is only for general purposes. And I've spoken around those slide points. So for that reason, we won't be issuing slides because we don't want anybody acting on this, on this advice in the wrong way. But what we will be doing is the recording of this webinar will be loaded onto the Business Accounting Network website, which you can go to under the events page, and you can go and click on free webinars, and it will be loaded probably by Monday. So yes, maybe the earliest Friday afternoon, but guys, I think realistically the webinar will be loaded by Monday or Tuesday. Okay, so the next question is from Genevieve. Hi, how long do we need to retain records for SARS? Good question, Genevieve. Okay, so you need to retain all accounting records in a printable format for 5 years after the last assessment. So if your taxes are behind 2 years, that means you have to retain those records for 7 years. So you retain it for 5 years after the last assessment. However, the Companies Act, if you're a company, most of these records are required to be held for 15 years. So it's not just for SARS. If you're a company, you need to comply with the Companies Act and retain those records for 15 years. Okay, I think is that all the questions, Shane?